Welcome to Tulane University. It is my pleasure to introduce our first session of the day, The Future of Utility Finance, Private Capital Meets Public Need. If time allows at the end of the session, the panel will take questions submitted by the audience. To submit a question, please scan the QR codes located on the screens. Please be sure to silence your cell phones. Enjoy the conversation, and please join me in giving a warm welcome to our moderator, Darren Olagues, Chief Development Officer at Talen.
All right, good morning. Y'all hear me okay? Yep. All right, good way to start the morning at 8:30 talking about utility finance. But it is a pretty sexy topic in the world that we live in, so we're excited to talk about it this morning. Before we get started, let me ask our panelists, do brief introductions and then we'll launch in.
Good morning. Larry Hand. I am Vice President of Regulatory Affairs with Entergy, Louisiana. By background, I spent about 15 years in New Orleans in private practice representing mostly oil and gas pipelines and the regulatory space, and then transitioned about 15 years ago to Entergy and focusing on the regulatory affairs part of the business, which, if you haven't heard, has been recently a hotbed of economic development and big drivers of capital needs.
Jeff Baudier. I am a Senior Managing Director at Bernhard Capital Partners. I also am a lifelong New Orleans resident. I started out my career about 100 years ago as a lawyer as well at a company called Texaco that a lot of you young people probably haven't heard of before. But then in around 2000, moved over into electricity and also moved from being a lawyer to the business side. So spent the next almost 20 years in utilities, mostly electricity with companies like NRG and CLECO, and now I'm on the private investment side with Bernhard Capital.
Good morning. My name is Jonathan Delorial. I'm a Managing Director at Bernhard Capital alongside Jeff. My background is a lot less sexy in the utility space. My career has been spent wholly on the investing and M&A side of things. But while at Bernhard Capital, we've been predominantly focused on the infrastructure space and more recently, increasingly focused on the utility space. Lifelong New Orleans resident, lived here, born and raised here, lived away for a while, but good to be here with you all this morning.
Yeah, thanks guys. So let me kick this off with a little bit of level setting as to why is this topic so important. CapEx needs in this business is, I think we'd all agree, probably facing an unprecedented outlook. And maybe just to, I guess, delve into that, let me ask the panelists to just walk through, beyond the data center AI, idea, which please touch on, but where do you see the CapEx demand coming from? And then we'll start to get into how it's financed and customer impacts and so forth.
I'll start. For Entergy, as a regulated utility, CapEx, utilities in general are very capital-intensive businesses, so you have to make very large capital investments, whether it's generator, transmission, distribution, even with gas businesses. They're fixed assets that very expensive to finance up front and very long-lived. So those have always been there for us. The drivers are the same. It's resilience investment, reliability investment, resource adequacy investment, and responding to storms. So you think about those buckets, they've always been there, they will always be there. What's different now is with the significant load growth, we're projecting seeing load growth, industrial load growth about a 13% CAGR, which is unprecedented. Wow. And to meet that need, it requires all the same investment types I talked about, but maybe double what we had seen in the past. So much more significant capital needs than we've seen historically.
Yeah.
And, you know, maybe what I'll add to what Larry's saying is that what we've seen change over the course of, I'd probably say the last 20 years, but it changed almost on an accelerating kind of basis, was how energy has been delivered. And think about it from the standpoint of, you know, start with Katrina, then go to COVID. And when you think about the way we've changed how we've lived over the last 20 years, everything used to be concentrated in a city, in a population center. Then people had to move away from New Orleans, and then COVID happened. People started moving out of the inner city into the less densely populated areas. Well, now what's happened with electricity and energy demand in general is it's become less centralized. And that has put burdens on things like the delivery system. And what I say all the time is we focus on the generators, we focus on the power plants that deliver it, but what's really more important right now is the transmission and distribution system that delivers that power. And that system had not historically been invested in the way we need to invest in it now. And there's only so much, you know, he's only got so much budget and capital budget to work with, so now we have to find new ways to develop those resources.
You guys have hit on most of the main topics, and I just summarize it in a way of, this has been a trend going on for a while. Utilities have needed increasingly more capital to meet the needs of renewable integration, renewable development, the changing population shift, certainly since COVID, to the more rural areas and less served areas in the country, but also resiliency and hardening from natural disasters. All those factors have come into play and are sort of meeting this moment where also you now have this load growth and steepening of the demand curve from a power generation standpoint. And so all those factors conflate into a very unique time in the utility space, particularly in the investor-owned utility space. And how do they meet that demand and that capital need from available sources? And so that really is the crux of a lot of what we're here to talk about today.
A couple of quick follow-ups on that. Pierre, you just asked this question. Is data center demand real? I get this question all the time in my job. We're going to make this enormous capital investment that is supposed to be a 30-year outlook, and is it really sustainable? Are we going to find ourselves in 5 years wishing that we overbuild the system, or the customers bearing a lot of stranded costs? I'm sure you guys hear that question all the time. Is it real? Do you think it's real?
You know, from my perspective, it feels very real, but I think that it's a healthy skepticism since for Louisiana, it's a new type of industry. What we're seeing at Entergy is a scale that is unprecedented, maybe, you know, in the world, certainly in the U.S., the scale of the investment. And so I can't sit here and say, I can't guarantee it's real. And the way we have approached it is to make sure the data centers that want to, you know, take the power, create the infrastructure needs, we're making sure it's real to them and that they are signing up, putting their money where their mouth is, and we're not building this on a spec that it will be real. We're doing it in a balanced way to make sure that they are in it financially with us. So if it turns out not to be real, turns out not to be as big as we think, we and our customers are not left holding the bag, that they have the skin in the game. They're the backstop, not our customers.
Yeah. Jeff, Jonathan, you guys are looking at all angles of investment around data center infrastructure.
So I would say it this way. Yes, it's real. You know, from an energy perspective, if you do a chat GPT search, it takes 10 times the power that a regular internet search, a Google search used to take. So the demand now is absolutely real. I think really what we think about is there's going to be a technology that impacts that demand. And so if you end up making these centers like twice as efficient, and then they, you know, 15 years down the line, they only need half the energy they needed, do they just, you know, do they put more servers in the data center, or do they reduce the data center? And, just the nature of this business is a power plant or a major transmission, investment is about a 30-year investment. That's normally how it's financed. And so you're making a bet for 30 years, and is the business still going to be there? It's not really, is it going to be there 10 years? But even if it goes away 20 years, there's 10 years of a tail of that investment. How does it get recouped?
Yeah.
Yeah, and we have a term in our industry, frothy. I'd characterize the broader data center landscape, AI landscape, as very frothy. There's a lot of money chasing data centers. There's a lot of money building new data centers, and all the ancillary needs, power most relevant, sort of being built and developed around that. I think it's very real. I think like most things that are frothy, there will be a reality that settles out at some point. That may be 10 years from now. I think it's very real in the moment, and the things that Larry and his team are doing in North Louisiana, that is very real. That's not, let's go buy it, you build it on spec and hope they come. And that is a very real opportunity for both Meta and for Entergy and for the state. And so those are the things in terms of where we spend our time. We're not on the speculative end of things. We want to be with the old metaphor of the gold mine, and we're not gold miners. We're selling picks and shovels and existing infrastructure. So in any case,
So demand real, CapEx enormous, and I just throw out one. I'm sure it was probably discussed yesterday, but the cost of power plants, which is probably a world I live in more, is enormous. Right? I think people know we haven't gone through a major gas plant build in the last 6 to 7 years. When you add on the kind of load growth that Larry was just talking about, it's this perfect storm of where we are severely deficient, really, natural gas-fired generation. Even with just a little bit of load growth, a fraction of the data center load growth, we will have issues. So CapEx is enormous, coming from all angles. Let's talk about how do we pay for it and the financing. I think people generally think, we all have some regulated perspective here, but in the old days, you just trotted down to Baton Rouge or visited the commissioners and said, we got a lot of CapEx to spend. We need to raise the rates, and here's the arguments why. Why is it different this time? Why is it different this time?
It is, it's different, as you said. The cost of the generation we need to add to support economic development, economic growth. When I started in the business in 2010 in the electric utility business, the cost of a new combined cycle unit was roughly $800 to $900 a kW installed. Today we're seeing estimates ranges on the order of $3,000 a kW. It's the same type of equipment. You have just the demand for it. So that escalation in price has caused us to think about it differently. How do we pay for it? Why do we make it different? Because the drivers for us, at least take Meta as an example, because they're driving such a large need to add new generation, we want to approach it differently. Typically, we would, as you said, you made it sound so easy to run down to the commission to get approval of something you need, and they just give it to you.
It's not that easy, Larry?
It's not that easy. So good luck with Delta Utilities. It's not that easy. But what we're doing with partners like Meta is they want to come here and be a partner to the state and not just come and say, give me your industrial rate, which are some of the lowest in the country. Give it to me just the same as anybody else. We've approached it differently, as have they, and it's more of a partnership where they're in it with us. And so that means for a lot of the investment, they're willing to front the money, what's called the contribution of native construction. So they're providing capital to take that off of our customers' plates. They're also agreeing to timing of energy payments on their ESA that start before, while we're building the plants, they're paying electric rates beyond what they're taking, and therefore it's not exactly construction work in progress financing, but they're contributing enough along the way to lessen the burden. So at the end of the day, we're not adversely affecting our credit metrics, which if our credit metrics were to decline, we're very vulnerable during storm season. We don't want that. And also, declining credit metrics means increased debt costs for our customers. We don't want that. So we're leveraging the interest and the balance sheets of these customers to help us in a non-traditional way. We're not just issuing fully debt and equity to pay for it. We're working with those customers on the timing of the load and the payments to help smooth it out.
John, from a private capital, I know you can speak from a Delta Utilities perspective, and I'll come back to that, but where do you guys see the opportunities emerging? And, what kind of LPs are looking, through BCP as a means to go deploy capital in this space?
That has a lot to do with why there's been so much of a private equity push towards utilities. Actually, private equity is certainly infrastructure, which is where our fund is at least part of our funds are focused. Our investors are pension funds, university endowments, retirement plans, union pensions, and these are people that are taking their money, that it's going to be their retirement, and they're not trying to get 30, 40% return. They're trying to get 8, 9, 10%, but they want it very risk-free. And so when you think about the relative ways you can invest money, Darren said a regulated utility may not be that sexy. Well, if you want 8 or 10% return, it's about as guaranteed it could be, that's about as sexy as it gets. And so that regulatory regime where you get a return on your equity and that return is very transparent and is provided by the regulated construct is a very, very safe investment. And I'll let Jonathan talk a little bit about, private equity has always wanted to be involved in these investments, but they were never for sale. And so one of the dynamics that allowed us to acquire Delta Utilities and the CenterPoint Utilities is because the market has changed where these assets have now become available to investors like us.
Yeah, I think the market available, or opportunities in the market available for private investment have been few and far between historically. Certainly as of late, we're talking about this enormous demand for these utilities to invest in their systems, whether generation or the hardening or all these, the factors that come into play. They've had to take, in our opinion, sort of an all of the above approach as it relates to where is this capital going to come from, whether it's issuing public equity, raising debt. Many are, similar to Entergy, kind of tapped out or maxed out on what credit is available. Then you've got to go to alternative sources, and that may be bringing on private capital, right? In the instance of, Duke, Florida just took on Brookfield as a private investor in one of their subsidiaries. You've got AEP sold 20% of their transmission business, or looking to divest wholly of subsidiaries of the utility. And so all this, in our view, is in an effort to meet that demand and that growing demand of capital need from the utilities. And for the first time in a long time, utilities have shifted from traditional aggregators and acquirers of these utilities to actually selling off portions of their portfolio. And so where private equity has stepped in, and certainly we would count ourselves in this group, is a very attractive way to put our investors' capital to work in a very risk mitigated sort of proposition. And so generating that regulated rate of return while also investing in these communities in which we live and work, from our perspective, a win-win.
Yeah. To pick up on that, Jonathan, so connect a few dots here. All of this major CapEx is making even the biggest utilities, Jonathan mentioned NextEra, AEP has done this, where they are looking at the CapEx needs and how they're going to raise the equity. And these are major market, public companies. And they are saying, the path of least resistance is actually to sell a minority interest in my transmission business, rate-regulated business. It's not just run to Wall Street and do another equity raise, because the cost of that, the dilution, people are looking for more creative ways. We actually have, the panel, you may know, is an interesting microcosm of that. Larry from Entergy, sold some of the businesses that started, sold to BCP, to Bernhard, the businesses that started Delta Utilities, I think, are, and so it would be interesting to maybe talk a little bit about, the sell side and the buy side of that. They freed up a lot of cash, focus on the electric business. They got a lot obviously going on. Spend a moment just maybe talking about the real kind of case study of divesting utilities and the birth of Delta Utilities.
And I'll let Jonathan start or Jeff, and because it's an interesting dynamic, right? The deal is closed, so we're not bidding against one another, but they're going to tell you how great a deal it was, and I am too, for different reasons. So I don't know if y'all want to start.
Well, I'm happy to chime in. So it was a great deal for everybody involved, and that's important in the utility M&A landscape. Is unique to other transactions that happen. It's a bilateral negotiation, right? It's back and forth, come to a deal, we'll close on the terms we agree. In a way, utilities is really a three-handed deal, right? It's you have to agree with the seller, and then you need to lock arms with the seller and convince the regulator, who is the third party in that negotiation, so to speak. And so it is inherently important that it is a fair deal, because the deal doesn't really work if the third leg of that stool isn't accounted for in that transaction. And I think Delta is a great example of that, because I think, and I'll let Larry speak to the real driver of why they sold, but my perspective is all the things we've been talking about. They needed capital. The gas business for them is a very, very small portion of the overall, rough order of magnitude. We're talking about a $400-ish million gas asset here in New Orleans and in Baton Rouge. They're today a $35 billion market cap, $39 billion. I don't know what the latest is.
Electric, yeah.
On the remainder of the business, you can just order of magnitude. This is a very small portion of their business. From our perspective, we saw a lot of value in having a pure play gas utility. And in combination with the CenterPoint assets that we acquired from CenterPoint in Mississippi and here in Louisiana, the combination of those two in terms of geographic footprint and our ability to invest in that infrastructure, from our perspective, gave us a runway and an ability to really have a dedicated gas utility and really garner value in having that focus, rather than being a very, very small portion of a much, much more larger pie. And so from our perspective, that transaction was a win-win-win for everyone, because I think it allowed us to kind of pursue and our thesis of having a pure play gas utility and continue to make investments, and I'd argue probably more investments than Entergy would be willing or interested in making, because of all the other higher and better priorities for their dollar. That's nothing against that. We may have that same view if we had a $39 billion market cap. But it gave us the ability to do that, but it also freed up capital and focus for Entergy. Now Entergy being a pure play electric utility and with massive growth opportunities and investing in their rate base. Everyone loves to talk about it because it's fun and it's meta and it's North Louisiana and it's all those things, but it's very real, and it's a very real need for Entergy to go serve. And so my perspective is a win-win-win, and now New Orleans has a very large $1.7 billion utility headquartered here that we're very proud to say is on our backyard, and that's great for the local community. That's great for economic development in and around the city, but also great and representative of the state, and so we're proud to do that.
So I do think, Jonathan put it well. It is a win-win-win. I think it's a win for Bernhard Capital to acquire that asset. I think it's a win for Entergy in selling that business. It did provide some capital, freed up capital that we can redeploy to the electric business. Also allows our management to, focus efforts on the growth on the utility side. That is not to say when we own the gas business, we didn't focus on that. I mean, the gas business, the gas service is critical to our customers, residentials, commercials, our community. So it was a critical business that we were focused on. I do think with a management team at Delta that is focused on that business as their primary business, it will be better for, the customers, the communities, I think the employees. The gas business required a lot of capital relative to the income, the revenue that it put off. And I think from Delta's perspective, it's better sized, right? It's a good place to put capital. So I think it is a win-win-win. It lets us focus on other things, but that is, not to say it wasn't important at the time. It was extremely important, and we're glad to see Delta stepping up to continue the investments that are critical to provide gas service from Entergy's perspective in New Orleans and in Baton Rouge. And I know CenterPoint is in North Louisiana, so you have other service areas.
Yeah. Because we're talking Meta, and I'm sure Drew Marsh yesterday talked at length about it, but I think we'd be remiss if we didn't talk about the Richland Parish campus. I mean, can you give us the recap of what's happening there and, kind of the CapEx spend that's needed? And I know you hit on some of the points, but just give us the 50,000-foot view.
Yeah, so for those who haven't heard, Meta is planning to develop a world-scale, hyperscale data center in Richland Parish, Louisiana. This is a business development, economic development site that was certified probably before I joined Entergy. The Franklin Farm site was, I think, purchased by the state and had been marketed to, you name the auto manufacturer. We as a state, as a utility, we hustled so many manufacturers to go to that site to provide jobs and opportunity in that area. We're never able to get one. Along rolls this data center revolution. Meta was not looking at Louisiana. They were looking in the South. We went and kind of poked our nose under the tent and said, what is it you're looking for? And it turned out they liked Entergy because we have experience building generation and transmission, but they didn't like Louisiana. They didn't love Louisiana yet because our sales tax policy at the state level was not accommodative to data center operations where you refresh the GPU, the processing units, every 3 or 4 years. The thought of having to pay sales tax on these refreshed chips every 3 to 4 years, that would mean, they're probably spending $10 billion every 2 or 3 years and paying tax on that was very regressive. So we worked with Jeff Landry's administration, the legislature, got those changes made, and once Meta saw that, it's like, well, maybe Louisiana is the place. We were able to get them here to do that, the scale of investment we needed. It is, I have friends in the audience, I think this is public, we do need to deploy 3 new gas generators to support that project as well as acquire some capacity. So, call this site being on the order of 2.5 to 3 gigawatts. If you read or you follow Mark Zuckerberg, you may have heard bigger numbers. If you listen to the President of the United States, you may have heard bigger numbers, but that is what is before us today. And so we're trying to tackle that and do it in a way, it's not just generation, there are substations that need to be built, a lot of transmission. From Entergy's perspective, it's probably, on the order of $5 billion of system investment that needs to take place. And we're making sure that Meta pays their way to protect other customers. And we talked about private capital earlier, different sources of capital. This is a tried and true method. You used to use it, Darren. I'm sure Jeff did as well. When a customer comes to us and requests that we make investments on our system that benefit only them, like a large substation or transmission interconnection lines, not the big highway lines, but like a driveway transmission project, we can ask them to make a contribution in native construction. We did that with Meta. So they are a large source of capital to pay for the substation work, the transmission interconnections, and the way we approached it on the generation side, because these will not be Meta dedicated generators. They will not own them or operate them. They're system generators. We set in the negotiation on the contract, we set the minimum bills at a level high enough to cover the fixed cost of the generation we'll need to build and the capacity. So it's very protective of customers, provides needed capital to actually execute. So that's kind of it at a high level. I'm sure
Great.
There'll be questions
That's
later,
great.
so I'll stop there.
Jeff, do you see opportunities for private capital to support this build-out?
You know, when you think about all the sort of multiplier effects that go off of a development like this, especially for a company like us, we're what's called a mid-market investment firm. So let's say our typical investment on the infrastructure side is maybe $300 to $500 million. When you look at a project like Meta, to put things in scale, one of our other utilities, our water utility, is building a regional water treatment plant in Ascension Parish to cover most of the parish. It's going to be a new water treatment plant on the Mississippi River. That's $200 million. The water treatment plant for the Meta facility is probably going to be $300 to $400 million. Just the water treatment. That's probably bigger than, you know, other than maybe Baton Rouge and New Orleans, the water treatment facilities for most of the cities in our state. It's the Meta. Tell people that Meta is like the equivalent of dropping a city from the sky, from a power, from an infrastructure standpoint. That, you know, you got substations, but then there was a story in you know, the news a couple weeks ago about Richland Parish. Now that, you know, hotels, now they have to build houses. Now that, you know, roads, all those things that will support this thing and will build a new community. But the sizing of all the component parts of those make great investments for a company like us, not to mention the fact that the other part of our business that Jonathan's very close to is what we call our services. There are several portfolio companies of BCP, such as Lemoyne and Epic Pipe, that are companies which we own that are working on that site and working on the construction or various aspects of that facility. And so, you know, the multiplication factors that give, you know, Meta's got all the money that they need, so to speak, but they don't want to be in the water business. They don't want to be in the construction business. So there's plenty of investments for folks like us to take pieces of that project.
Yeah, I think that's the other dynamic at play. Just as much as the utilities have massive capital needs and opportunities to invest in capital, the Metas and the hyperscalers of the world have tons of opportunities, and they need to build these as fast as possible. And time is as important as cost. And so to get into market and have the blinking lights on their servers, like, that's the goal. And so the scopes of that, there's 7 substations at the Richland site, privately owned by Meta. That has nothing to do with Entergy. That's just to accept the electricity load. Is Meta an electric company? I mean, owning substations, that's not their business, nor do they really want to be in that business. And those that we're using Meta as a microcosm of broader sort of infrastructure, but firms like ours, the private capital universe, has certainly been a solution to, you know, meeting infrastructure needs, where, you know, the ultimate owner and owner of that asset may or may not have an interest in owning a portion of it or bits and pieces of it. So firms like ours are able to very creatively structure around solving that need.
That's great. It's great to hear these big numbers that get thrown around on CNBC about CapEx spend, and then they hear, like, this is what's happening on the ground on the CapEx level, you know, middle market spend, major CapEx spend of the utility, all being borne largely by you know, by the hyperscalers or data center developers. Let me pivot to the customer, right? Because the customer and the regulatory drivers of that is certainly a risk consideration in private investment. I think we've said the word sexy too much, so I'm going to stop. I'll leave it there, or lack of. But you know, if you follow this industry around the country, it's a little less so in Louisiana, given the vertically integrated nature of it. But, you know, there is the example of Indiana, right? Just last week said no mas to any more large load additions, right? And you see that, you know, happening in PJM or happening in Dominion service territory, where the load requests are so great, it's overwhelming their ability to both do the analysis and think about how they're going to deal with the CapEx and the power plant needs and the time frame. You know, it's, well, we can add this, but where's the power going to come from? Because a new power plant's going to take 5 years to get here. In terms of the customer, let's bring it down to the retail customer that's ultimately bearing this, how did they think about this CapEx spend? I know we talked a little bit about stranded costs on the back end. Entergy has done a great job, I think, and was able to get the CapEx approved, that CapEx plan, because they're tempering that effect on the customer. But, you know, it's certainly a topic. Is the customer bill is rising at a rate that it feels unprecedented outside of a major commodity move. How do we deal with this? How do we spend the money and not crater the customer?
Yeah, and from Entergy's perspective, we do have an obligation to serve all customers who come to us and are willing to pay the cost to serve them. So it's not like we can just say, we're not going to serve you, Meta, we're not going to serve any of you in the room as a residential customer. So we have that obligation to serve, but we have an obligation to make sure we can serve reliably the customers we have today, and that bringing on a large load like Meta does not jeopardize the reliability of service we provide to our existing customers today, or as importantly, cause the price of electricity to skyrocket. In Louisiana, we're fortunate to have, just on a residential basis, our average power prices in Louisiana currently around 12.5 cents a kilowatt hour. You look nationally, those average power prices nationally are 17.5 cents. You go to some markets that are more deregulated and seeing large load additions without commensurate capacity additions, and that's the issue. When you add large load without adding the right amount of capacity, you can see wholesale power prices go up significantly. And I think Entergy's approach is we are not going to recklessly add large-scale load that's uncovered without capacity. And so our balance is to, yes, we want the economic development, the tax benefits, the jobs, all the ancillary goodies that come with these large-scale projects, but we need to make sure we do it in a way that we time it so when we can deploy the generation to avoid resource adequacy issues that are being seen in other jurisdictions, wholesale power prices. Because if we don't do this right as a state, if we don't balance our load and our load requirements with the resources to serve them, we can see significant reliability issues. We think about loss of load. It should be once every 10 years. That number goes up astronomically. If you add 1,000 megawatts of uncovered load without generation, your loss of load probability goes up 150 to 300%. You add 2,000 megawatts of uncovered load, you're talking about a 900% increase. So we got to do it right, do it responsibly, and balance ramping up that load with the generation, or tell that customer you're going to need to be curtailable, interruptible first. Because we can't sacrifice service or price to our existing customers.
So I'll use that to go to maybe the last question, then we'll open this up to questions. But, the company I work for operates in the Northeast where the business model is different. And this issue that Larry was just talking about is how do you bring on new generation to meet, and mainly in Pennsylvania, the amount of additional load that is coming there. And it's causing the hyperscalers to say, this model's crazy where you guys are working. Let me go down to Louisiana, where I can go down to Baton Rouge and talk to the regulators and talk to one voice with Entergy there. And that is a broad issue that people in the Northeast worry about, that they're going to chase the crazy regulatory policy. It's going to chase it, all this data center demand to, in some ways, Texas and Louisiana, and you see that happening. But I'm going to use that as a segue, kind of last question here. Give us the bull case. I know, I peer over back to Louisiana from Houston, and there's so much going on that's positive for Louisiana. What's the bull case on capital spend, industrialization, data center? Obviously, there's storm hardening, but give us a bull case.
I mean, the bull case for Entergy in Louisiana is we have, no matter where you are in the country, if you want to add large load, you need to build generation, you need to build the resources. We have the resources to do it. We have the history of doing it. Since I've been at the company, we have built in Louisiana 3 new combined cycle units. Each one of those has come in ahead of schedule and under budget. There's a larger demand for it, so we're all chasing the same thing. We all need to go find the turbines. We need to find the builders, the designers, the procurement. We all need to do it, whether you're in Texas, anywhere else. I think we're positioned to beat everybody else, speed to market. And with the market we have, without making sure we don't change it and inject uncertainty where it doesn't exist today, I think this is the place where people want to be. I think some of the folks we are dealing with, data centers and otherwise, look at what we have and say, this integrated model works, and it can move faster than we've seen elsewhere, and we want to be here. So speed to market, our workforce, our resources are why people want to come to Louisiana.
Yeah, good stuff. I mean, Jeff, BCP, Jonathan, you guys own a lot of the companies that are doing the ground level work.
Look, it's very exciting because, look, this conference is a great example of that. I mean, yeah, the data component of it is a major discussion point, and everybody kind of feels, well, Louisiana, it's our turn now, it's our time. But look at this conference, you know, LNG, you know, carbon capture, the chemical business. There are a whole bunch of other areas where we're hitting right now in Louisiana. And I think what's really exciting, certainly to be doing what Jonathan and I are doing, is, you know, to the young people in the audience, and certainly those of us who grew up here and spent our lives and want to raise our families here, it's like, do I stay, right? It's like, do I stay or do I go, you know, somewhere else where there's 20 jobs, you know, on my way to work? And one of the things that I think we're really excited about is we can be a part of bringing Louisiana back, of bringing New Orleans back. And we've literally bet our lives on it. I mean, we're investing in these things ourselves. And like, what I think about is, look, if you graduate from here and you're thinking about what you're going to do, what better thing can you do than bring back your hometown, your home state? And it's like, if we don't do it, who's going to do it? And so they got meta because they went out and fought for it. And now I think we've kind of realized that, like with economic development in Louisiana, it's not just going to fall out the sky. You got to go get it. And if we take that mentality that, like, here's our strengths, this is what we do, and this is why you want to bring your business here, and then we're going to also bring the capital and the investment and the employees and the land and the resources and the government support to make it successful, then we can make it happen.
And Jeff alluded to sort of our bet on Louisiana, and he's right. We've bet our lives and our careers on much of the things he talked about, and to me, it's an easy bet to make because I see not the least of which of what we've been talking about here, the opportunities in our backyard and for the state in the energy space specifically, but we mentioned the LNG space, we mentioned carbon capture, sequestration, the Hyundai steel plant that's coming here. The sort of reshoring and industrialization, I think, is great for broader economic growth. But as it relates to sort of New Orleans, specifically in terms of the broader state, the workforce development, and I think people are recognizing Louisiana as a great place to live and to work, and to be sort of a part of that and catalyze some of that growth through our investments here in the state and focusing on opportunities for those investments to really impact these communities. I mean, I think that's a very small part, but you definitely get the sense, and there's a feeling that the state is headed in the right direction in many ways, particularly from an economic development standpoint. And importantly, it does feel like the problems that we face, the biggest problems that we face, have solutions. Maybe not easy ones, but there's a way to solve many of the problems that we face as a state. And so I couldn't be more thrilled about being here as a lifelong Louisianian and New Orleanian. Couldn't be more thrilled about being here and being a part of this resurgence.
Good stuff. A couple of minutes left for questions. Anything you want to poke on?
Unfortunately, we do not have time for questions.
Oh, we don't? All right. Well, hopefully that was informative and helpful, but so appreciate the panel.
Thank you.
Thank you, guys.